So there was a tweet that went around yesterday that showed that Thursdays was like the worst day to have a 1% decline or more on the S&P 500, because usually the next day was on average negative. Every other day, the average was positive. The markets bounced. There was some chatter about, well, let's just close the market tomorrow and not even do it. And it looked promising for a good chunk of the day today that we would actually kind of avoid the downside. But we followed through with yesterday's weakness with another move down today. We're going to break down this move that we've had now on a weekly basis to kind of see some very interesting patterns that are very telling as to what we expect to see going forward. I'll tell you what I expect to see. Of course, it doesn't mean that I'll be right, but based off of precedent and based off of these patterns, I'll tell you kind of what I'm expecting. And then I'll also kind of tell you what I'm going to be looking for that would change my mind, especially in the short term, as early as next week. So next week, as always, can be a really pivotal week here from a technical standpoint. So we're going to take a look at what we expect to see, and then what can change that, what we can see next week that can get it going in the opposite direction. So we'll break all that down. Some very interesting patterns on different asset classes that's driving a lot of this bearishness really over the past couple of months now, because this all started in August. And we'll kind of get an idea of what we can expect to see going in what is traditionally a very bullish time of year, especially when we're bearish in August and September. We usually end up the year very bullish. So we'll take a look at what how our expectations go into the end of the year here. So, and then our trade idea is a stock that looks very much like the market. So we'll put a trade on it. So let's go ahead and get started. Today is Friday, September 22nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here with the thumbs up icon. Click that tab, hit that like button. Again, that really helps us out getting our content out to all of our followers on those platforms. That's why we always ask for it. So our goal is to get to 100. We took a big dip yesterday. Like I said, it wasn't typically a day I do the Market Outlook video, so that might be a reason why. But we took a dip yesterday, and let's see if we can get a little bit closer back up to that goal. Again, thank you to those of you who click on these likes day in and day out, and those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So we finished our week. It's interesting. Remember we started the week with our 11th Monday in a row to the upside, not counting Labor Day Monday because we didn't have one. But 11 in a row, and I believe it was 11 in a row. And then like the rest of the week down. So that was kind of similar to what we saw kind of back over, in this stage, when we were getting like the one up day on Monday, and then the rest of the week was down, right? The one up day, and then the rest of the week was down. And, this is kind of how it was back in the summer during the early part of the streak. Here was the one up day, and then the rest of the week was down in July. So we had that stretch over there. It's the same thing happened this week. One up day was Monday. The rest of the week was down. Our short-term sentiment continues to sit at really, really extreme levels, below both of them for a second day, below the 5th percentile. The momentum line's been below the 5th percentile now, below the first percentile or 3rd percentile there for 3 days. So I mean, it's a big drop in just a short amount of time relative to what we had been seeing, right? And so obviously you're down, what is this now? 2.5%, 2.7% below. 2.5 is kind of that time where you begin intermediate declines. We have dark pink shading and a red line for the second day. We're kind of starting, again, this period of time where your dark pink shading and green and a red line might not last very long, right? You can see some of these intermediate declines didn't last very long at all. But when they're in corrections, they can last for a while. So Keep that in mind. The intermediate line, obviously in bearish territory. Short-term sentiment, as extremely low as it is, suggests we'll probably get 12 Mondays in a row to the upside. You would expect that we'll come out of here. The Russell 2000 formed a cluster every single day of this week on the market forecast indicator. Every single day of the week, because it was down on Monday. We formed a oversold cluster. So last time we had 5 in a row was back over here, again at the right near the August lows, and we were a lot. I mean, we were more than nearly 10%, nearly 11% below the 30-day moving average at that point, and right now we're not even 5% below. So it's pretty bearish, but not really that bearish. Kind of fascinating to see the differential there. The NASDAQ 100, of course, is still your more bullish index out of all of them, and it still shows a rather bullish pattern. You can see it was actually up today barely, even if it was off of its highs of the day. Because of its move down to the lows of the day, the short-term sentiment remained oversold. I didn't mention the Russell 2000. So we had these clusters, right? So the first cluster, that everything drops below 20. The second cluster here, everything was below 10. So you've had not only 4 days in a row of clusters, but you've had 4 days in a row or 5 days in a row of clusters. You've had 4 days in a row of clusters with everything below the 10th percentile, much less the 20th, which is what actually defines a cluster. Then you can see here you were still, the intermediate line was still barely below the 8th percentile. But the last 2 days, you've had both lines below the 5th percentile. I mean, look, the intermediate line, in fact, they're all below the 1st percentile. The intermediate line's at 0.97. The momentum and near-term lines are practically at 0. That is one of the lowest clusters that you'll see. One of the most oversold clusters that you'll ever see. That's pretty extreme. Again, and we're only 4.5% below the moving average. So we're not even that it's not like we're falling off a cliff here. But it goes to show just how clearly one-sided the sentiment is in the Russell 2000. Finally, looking at the Dow Jones Industrial Average, which has had its periods of time where it's been more bullish. It's breaking down below its August lows. It came that close to getting its own cluster. So 300ths, a little bit less than 400ths of a point from getting a cluster, right, with all 3 lines below the 20th percentile. And you're not necessarily quite below that 2% mark. But again, on the Dow and the Russell, you see how we both failed getting that bear tag. Now let's take a look at some of the weekly charts on the market forecast. You see some interesting patterns here. So let's go out to a weekly chart here. We are that close to getting a bull tag. Now, bull tags, typically start corrections, right? Bull tags don't necessarily start just little pullbacks. You get pullbacks down to the 30-week moving average. Bull tags start corrections. Unless, as you saw, for example, here in March, we didn't quite get the bull tag because you had a red line for 1 day. But the reality is that was kind of the same setup as what a bull tag would present. Light pink shading and a yellow line. Like I said, it was a red line, and that's why we didn't get it. But it was just barely red. So same idea. And the Fed stepped in, right? The Fed increased the balance sheet. Really bad week, and the Fed stepped in, and we were okay. Same thing in 2019. Really bad. We got a bull tag, looking like we're about to start a correction. The Fed stepped in. We had 3 rate cuts. The Fed started increasing the balance sheet again, and the market rallied. The Fed's not stepping in with rate cuts at this bull tag. They're not going to step in with increasing the balance sheet at this bull tag, just like they didn't over here. In fact, back here when we got that bull tag, not only did they not step in, but they started raising rates eventually, and they started increasing the balance sheet eventually out that bull tag. So I think you're going to see a similar scenario set up here probably next week if we were to close below this moving average next week. So we'd still be in light pink shading because we're just barely below the 80th percentile. You can see the last time we got this bull tag, we closed at the 75th percentile. On this bull tag over here, we were at the 77th percentile. When we started this bull tag, we were at the 77th percentile. That started that correction there. So you can see these bull tags can really start these declines. You can see in 2015, 2014, coming off the Ebola, and you know, we were kind of like when China, we started to have some weakness there in China. It led to a global slowdown, but we were still kind of holding up here until later in the year. By that time, we were at the 73rd percentile on that bull tag. And of course, you can see 2012 a few times where we were threatening with correction. 2011 in June, and eventually there in July, right before the credit downgrade, we had, you know, bull tags that started the correction. 2010. So it looks like we're headed towards that right now. The Russell 2000 already is below its 200-week moving average. We didn't get the bull tag because we never did close below that, and now we're just red. Now we are like it's the same idea, but we ended up just getting dark pink shading and red line. It's kind of like what happened over here. Like by the time we had this little fake out move, you would say that this is the fake out move. We came back down. By the time we came back down, we were at red line that quickly. So we never really did get the bull tag that started that one. And it doesn't look like, again, dark pink shading and a red line already. And your intermediate line didn't get below market sentiment last time during the banking issues. We'll see if that ends up being the case here. The short-term sentiment, of course, very, very bearish. Your NASDAQ 100, of course, that's a different story. It's very... I mean, short-term sentiment's getting bearish, but you're still dark green shading in a green line. Again, goes to show just how strongly bullish the NASDAQ. Very similar to what we saw at the end of 2021, where it is holding up, but you're starting to get some really volatile short-term sentiment lines that you tend to start to get at the end of these bullish stages. Like, you don't get, when you're bullish, you don't get the near-term line this low. You don't get the momentum line down to extremes until you get to the late mature stages of the bullish cycle right before things turn around. And then finally, your Dow Jones Industrial Average, again, you can see it is that's how close we came to getting a bull tag here. And last time we got a bull tag, we bounced there in May, and kind of same thing with the financials. This time, though, again, look how close you are to crossing below the market sentiment line. So we are that close to, like, again, you know, these correction. I showed last night a lot of indicators suggesting the breakout move. Like, and I said, you know, we are just getting started. This is how close we are to getting some correction signals. Again, when I say correction, I mean my definition of correction in bull market is a little different than what most people. For me, a correction is when you break through the 50-day moving average and you fill in the gap between the 200. Not that big of a distance like we saw back here, right? That was one of your biggest corrections, because it was also one of your bigger gaps that we've seen between those two lines. In fact, you could argue that was the biggest gap that we've had that we actually filled in, because in the 90s, the gap had shrunk by the time we started to fill it in, by the time we corrected there. That wasn't the case in 2022. If you look at the gap here between the 50 and the 200-day moving averages, go simple on both of these. I mean, as big as that gap was, that's when we started to correct at its peak, and that, like I said, wasn't the case back in the late 90s. That wasn't the case back over here. Like I said, by the time we started to correct, we were well off of the highs, right? We were well off of the highs there in late 2000. And we were kind of in that 20% mark. Over here, we started to correct immediately at the 30% mark, and we're down. And then now you can see it's a much smaller gap at only 5%. And in fact, this would be one of your smaller gaps, as you can follow my cursor along, that we would be starting a correction with. So the correction would be as big as this correction was. A lot of people thought it was actually bear market. This would be one of your smallest corrections, which means there's a good chance we probably get through the 200-week moving average. And then obviously once, we've seen that before on a correction. But once you get through and stay below is when you're in bear market mode. And that's no matter what the number is on the pullback, that's when you get into bear market mode there. And we'll see what ends up happening there. This is, you can see, breaking below that 17-week. Things have changed. Let me show some other weekly charts before we get back to this. You can see on the market forecast, We are, bearish there, breaking below the 10-week moving average, 10-week exponential moving average with the red arrow, falling PPO, pretty bearish, right? The Russell 2000 actually did close easily below the 200-week moving average. You get below the 200-week moving average, again, that's when corrections start, especially when you're that far below. If I were to change this here and say, okay, how far below are we below that moving average? And again, you can see, if you follow my kind of cursor along there, we did get pretty decently below it during the banking crisis, and we started the death cross environment there. But remember, the Fed stepped in there. If I were to zoom out a little bit, you can see also in 2019 we had gotten below, and the Fed stepped in here too, with again the mid-cycle adjustment, the increase in the balance sheet at the end of the year going into COVID, and then the bazooka, right, of the 0% interest rates QE4. But this is a pretty decently low level to get below that moving average here that you would expect would start a little bit something more, barring some intervention on either a monetary or fiscal basis, which we are not expecting on either basis here. Let me show you as well the whole. Let me first go to the Russell 2000. You see how bearish we are. The 200-day hole is turned down. It's the first one that's turned down on the. See, we're actually still up. Well, the S&P finally turned down today on the 200-day hole. So that's the first one. The Qs have barely. So I say the Qs haven't yet, but they have now. It's the diamonds that haven't. The diamonds still haven't turned bearish yet, but they're starting to turn. So we kind of turned bearish in the banking issue, but by the time we turned red, we were already back above the 20-day hole and going to the upside. Obviously, not the case right now. And to kind of give you an idea of what it looks like when it does turn red, and when it turns red and we are in bearish mode, again, we can be down here for a while. So even over here, by the time you turned red, we were already bearish and we were already kind of bottoming out during that pullback and turning up. So a little different story here where we're getting lower closes and pretty bearish, and the PPO is pretty bearish down there. But I wanted to show you the weekly chart. You can see how bearish that is on SPY, but look at IWM. We did close below. See, not the Hakinashi close, but the actual close. This is measuring the actual close relative to the 200-day haul. It did close below the moving average there. So that's a significant change. You can see when it goes negative, it's when things turn around. And what's interesting is the last time it turned negative, we had green 200-week haul. Over here, when you went negative, you had a green haul. This is the first time in quite a while. If I were to go back even further, let's zoom out a little bit here to see. Over here, where you went green in 2018 during that correction, the 200-day haul was green there. Over here, when we turned below it, we were green still in a 200-week haul. In 2015 and 16. Coming into some of these others, you were green that whole time at the end of 14 when we were flirting with that correction there. 2012, when we had dropped below zero, flirting with corrections there, we had turned green. Thank you to QE3 to avoid that one there. 2011, we did get a correction. We turned south. We were already green. So, you have to kind of go out. Even in 2008, when we were in bear market mode, you never got above it, the 200-day haul. So it's rare for us to get above it and turn back down and turn negative again below it without it being green, right? The haul is actually still red. So it kind of goes to show that, that we might still actually be in, that first correction, that kind of multi-stage, longer-term bearish market. As we are potentially starting a new run below a negative level, again, on a weekly chart here. Let's go to some of these other oscillators. The 3 green arrow chart, you can see again, we're going to have 3 red arrows, for a while. We're not failing on these and bouncing up. So, like we are in intermediate decline, and that's pretty obvious. Looking at the 2-line version of this chart, you can see again the 8 and 17 day are below the 30 now. The MACD is negative and falling. Stochastics is bearish territory. So we're, obviously things have turned bearish there. What's interesting to me is, excuse me, the Russell 2000 again. It's below its 200-day moving average, pretty easily below the 200-day point of control down there. It's also below its 200-week. I mean, look at that breakdown below the 200-week. Again, it's a little similar to the banking issues. Like we had started the week well above it, finished the week well below it, and then we just didn't extend. Lots of big ranges here. This is a little different in that we did not start the week above it. We actually started the week below it. And then this big move, this made it worse, right? So a little different scenario there. We also, on a lot of these other times that we crossed below it, we were so far down below the 30 and the 50, so far down below the 30 and the 50. This one, again, we crossed below all of them, but again, we had crossed below all of them. We started above it. This is the time that we're actually crossing below the 30 and the 50. We're not so far below them. We were already below that. In fact, the 8 is crossing below. The MACD is turning negative. It's a little bit more bearish than what we've seen. I forgot to bring up on the market forecast chart here on the Russell 2000. Here's something that's interesting. Dark pink shading and a red line on the Russell 2000. Dark pink shading because we finished barely below 50. Dark pink shading and a red line for the first week on the Russell. And look at the monthly chart. Right, going to the monthly chart here. Let me just save that. So dark pink shading and a red line on them because we're a week away from the month and probably going to finish dark pink shading and red line no matter how good of a week we have next week. So here we are with, depending upon how bullish we end up next week, we could finish September with dark pink shading and a red line on the Russell 2000 across all the time frames, the daily time frame, the weekly time frame, and the monthly time frame. That is bearish. That's a bearish combination that you just hardly ever see unless you are in bear market mode, right? And the Russell 2000 may very well be kind of showing us where we may be headed. So, I mean, this was the correction for the Russell 2000. This was the bear market of that move. This is the correction. This is the bear market. If I were to go back even further, go all the way out as far as we can go to 2000, there's the correction, and then there's the washout phase of the bear market in 02 when it finally turned dark pink shading and a red line. So you can see it just doesn't turn dark pink shading and a red line on a whim, on a monthly chart. That's how bearish we are and have been on the Russell 2000. And especially, we had 2 great months in June and July, and they completely reversed practically in August and September. So, again, the intermediate line is at its lowest level. Look at how low the intermediate line is. The lowest level since 2008 on the monthly chart. That was bear market mode. This is bear market mode for the Russell. And you can see it's not getting any better because the near-term line is still slightly above the intermediate line, but falling, right? They're both falling. Momentum line back to extreme lows. That doesn't happen in bullish markets. It doesn't get to extreme lows in bullish markets. So again, you can kind of see just how really negative things are for an index that is does not have the Magnificent Seven in it, right? So at all, 0% weighting to the Magnificent Seven. And so you can see how important those stocks have been and how an index that does not have those stocks is really struggling. And it's kind of more of a reflection of what's going on in the U.S. economy more so than what you may see on Wall Street when it's dominated by those large cap names. Of course, you're still getting the today's move. This perpetuated these breakout signals I mentioned yesterday on the DMI. The RSI and the CCI had an important signal today. Again, still below 200. I mean, that's crazy to have 2 days in a row below minus 200. Again, we haven't had that for a year. To kind of give you an idea. Again, this doesn't happen during just normal pullbacks. Here, let me put a line here at 200 so we can see the how many times we actually finish below 200 multiple days in a row. So over here it was just we did have 2 days over there during that, and we had almost 2 days there. You can see again during that banking issue, which again we were saved from by that increase in the balance sheet that provided that liquidity. We got pretty close to it over here during that correction, pretty close to it over here too going into this correction. But again, you see just how rare it is. Last couple of years when we have been in a really bearish correction, Like we don't generally do this. We're below 40, easily below 40, so we're still in bearish mode here on this. So we can just keep this going. We're still in bearish mode, but we are done now with that green box there. Right, that's it. Because if you notice, like we're below minus 100. We have crossed below minus 100 on the weekly CCI. That means that we're done with the bullishness. As you can see there, we didn't get to that weekly chart here, but I mentioned on the Russell how we broke below the 200 week. The S&P has clearly broken the 17 week. The MACD was already below its moving average, so we were already converging. But this is a clear breakdown of the 17 week, which again typically starts more of a decline as we head towards these moving averages. That once you break, you are in correction mode. So I mean that's a clear break, and your MACD is not even below zero yet. Like I said, the IWM is a little different because it's it's clearly breaking below the 17 or the 200, and we had already broken below the 17, but now its MACD is negative. Stochastics is in bearish territory. I mean, this is not for the faint of heart, not in the least bit for the faint of heart here. The Ichimoku cloud, we're below the cloud, negative rate of change. We have an intermediate trend strength. So I mean, this is at least pullback mode. IWM is also at intermediate trend strength, heading towards more mature levels because we are clearly below the cloud, significantly bearish rate of change. The Qs are still, have also kind of broken below that cloud there, below the blue line. You have a almost intermediate trend strength going on, almost below that -2, already above 65. So you see how things are changing. The Bollinger Bands, we closed below that lower band yesterday. We talked about that being the breakout signal. We also closed below the Keltner channel yesterday. We are still below both the band and the Keltner channel today. The momentum is picking up, and you can see it's just getting started to the downside. So for some context, I think I showed this to you yesterday, but for some context on how bearish that momentum can get, I mean, look at all those momentum bars over to the left while we were actually in correction. And this is where we're at right now, where my cursor is. So follow that gray line across, and you can see again, if we're going to be in correction mode, we are just kind of getting started here on this weakness. Let's look at the volatility index, which again also goes to show that we are nowhere near washout mode. We're not above 20. We're barely above 95. It's the first week we've closed above 95 in a long time, in multiple weeks. In fact, it was the week of the banking crisis. So we closed at 97%. So we didn't even close above 100% there. But that was the highest week that we've had. Before that, it was going back into last September, going into those October lows on the S&P. So, I mean, that goes to show things are different right now. But again, we're not above 20. We're not above 100%. So we're nowhere near like washout, like holy cow, this is so bearish. We've got to bounce off this extreme. We're nowhere near extremes. When you look at the VIX relative to its moving averages, its average values, we are above some of these average values, the 8s. The MACD is clearly positive. Stochastics is stronger than it's been in a while. You can see, this is an indicator. This is an instrument that the stochastics doesn't get very high for very long, unlike the stock market, where it can get up here and then stay up here for a long time. It generally just kind of goes up quickly. I mean, even if you look at the weekly version, we're still pretty low compared to some of these levels it got to during these correction phases, during COVID, during that correction over there, during this correction, during the washout phase. You can see how strong that stochastics and MACD got. Like, we're still in infancy stages here of volatility ramping up. Again, not even above its 200-day moving average, not even close. And then you can see again too, when you look at the VVIX, which measures the volatility of the VIX, it's it generally gets pretty high too during like stronger. I mean, even during the banking crisis, we got all the way up here to 125. We're at 90. We're at 90. During the COVID, you see how high it got. During the beginning stages of this correction, we were in the close to 150. We're at 90 right now. In 2018, at the beginning stages of that correction, we got up to 125. We're at 90 right now. During that initial pullback, that was kind of a really weak correction, we got up to 165. 15 and 16 at the beginning of that correction, we got up to 140. we're at 90. So again, we are in infancy stages. If we are indeed moving towards correction, we haven't even started it from a volatility standpoint yet. Like, things haven't hit the fan yet from a volatility standpoint, because remember, the VVIX always jumps first and then the VIX jumps next, and kind of follows suit, and then it's done, right? Then it just stays elevated as we kind of get up big moves up and down. But we're just getting started. You can see, as I mentioned, this is one of our bigger down weeks we've had. It's our first almost 3% down week that we haven't had since, or that we haven't had one this big since that banking week there in early March. Again, we were saved. But you can see it's this type of decline that started the correction, and same thing as you can see in 2020, going into 2018, right there. These are the kind of moves that start corrections. Obviously, you get down to like 5% or more, now you get to washout moves. But when you get down to like 3, a little bit more than 2, 3%, but the VIX as low as it is, again, we may just be getting started. I expect that we're just getting started here, barring some kind of intervention that we've seen in the past, summer of 2019, March of earlier this year, barring some type of liquidity infusion, some kind of intervention there, which we can't, we can't, like the Fed has basically said this week that they're not going to do that, but who knows, right? Who knows what the market, whether it's the Treasury Department or the Fed or whatever, can come up with to improve sentiment and inject liquidity. But barring that, again, we're seeing technical signs that we may just be getting started. All right, now let's take a look at what's driving the price action today. You can see we started the day okay. I mean, the Qs were up over 1%, and then the Qs ended up barely positive by the end of the day. One last hurrah at the end of the day before closing at the lows right into that last hour. The last hour started with a little bit of a rally. You can see real estate continuing to get hammered. In fact, if you zoom out to this entire week, remember we've gotten a cluster on the Russell every day this week. You can see real estate had the worst week out of all. Really, early in the week, and then the last 2 days was really such a down week for it. The Qs were down over 3%. IWM was down almost 4%. S&P almost 3%. You can see emerging markets, developed markets outpaced despite a strong dollar. They outpaced U.S. equities. Again, goes to show where the margin of safety is, right? U.S. equities are a lot more highly valued right now than any of those major areas, international areas. Bonds were down big this week, off their lows of the week, but down big. They started off, first 3 days of the week, they were higher. And then the last 2 days, yields really took off and bonds fell. And you can see, too, the dollar was actually weak until the last couple of days. Commodities outpaced bonds. Commodities outpaced equities. The only thing commodities didn't outpace were high-yield bonds, which, there's a lot of energy stocks in that high-yield area. In fact, when you look at the high-yield area here, it still hasn't even really dropped. Like, this is an area, when you compare it to treasuries, that when it drops, it closed below 30-day the last couple of days. You've got a pretty sizable gap here between the 50 and 200-day moving averages. So things are starting to look a lot more bearish for this index. But it kind of goes to show, this is not how pullbacks end. This is more, you can see back in March when things were hitting the fan, you see how this index got. And obviously we're nowhere near that. If I were to go back to a few other of these corrections that we've had here recently, you can see 2022, how bad it got, the ratio got during the correction, going all the way into that June, July low, and then eventually into the October low. COVID, you can see what happened. 2018, you can see what happened. Again, these are all corrections, and we're just barely breaking the 30-day to moving average on the ratio. The MACD hasn't even turned negative yet. The PPO is still long-term PPO is still high. We're just turning into negative levels on all of these oscillators, including the RSI breaking below 50, CCI breaking below 0, but they're not to bearish levels yet. So another indication, in addition to the fact that the Qs also haven't started to break down either. I mean, the ratio of the Qs IWM is still above its 8-day moving average. The correlation is still negative, slightly negative, so it hasn't turned up yet. And when it turns up, then both lines are going to start moving in the same direction. Which way? Are they both going to move up from an already extremely high level that's forming divergent highs, or are they going to both move down, which is what you would expect when you have such a large gap between the 50 and 200-day moving averages and what happens during most corrections here. Few interesting items here. Of course, I told you yesterday the importance of breaking below 200. We stayed below, or 150. We stayed below 150, stayed below 100 for the second straight day. So the breadth was really bad. We are below 250, easily below 250 here as well. Kind of watch that 200 level to see if and when we do break down there to kind of confirm this bearishness. But we are below 250. That's an important level from a breadth standpoint. You saw the new highs and new lows, still below minus 500, so still very bad breadth. That is more typical of significant declines. Again, the last time we were this low was in March. And again, where the Fed kind of stepped in here and stabilized the markets. The Fed's not going to come in and stabilize the market. That's why we're doing this. Here's another interesting factor. Look back in March, like when things hit the fan, the skew dropped. It wasn't very high to begin with, but it dropped. I mean, it's all the way down to 118. When we get these corrections, let's zoom out a little bit more so you can see some more. Like COVID, look how far it dropped. Even this intermediate decline there, but then you see how far it dropped during this correction, all the way down below 115, 112 and a half. Fourth quarter 2018, it dropped down there. 15 and 16, it dropped below 120 from relatively high levels. We're still at 135. Like we're still really high. Like as bearish as we've been the last couple of days, the skew hasn't really dropped. And usually the skew drops even during intermediate declines. Usually the skew will drop here to down here like below 120, like well below the moving average. You'll get these big drops here, like we saw in August on the skew relative to its moving average. We haven't had that yet. You can see during some of these declines how big the drop, how low the MACD gets. MACD is barely negative. It's barely turned lower. We just haven't had that big jump, a big drop in the skew, which would suggest that there's no fat tail risk left. According to the options market, there is actually still plenty of fat tail risk left, which means, again, another way of saying that we may just be getting started here. You saw that how things have performed this week. Let's go all the way back to August the 1st when this whole thing started, right? Because July 31st is the highest close. This is, again, the dollar's up, commodities up, and yields are up. That's the three-headed monster that's producing all this bearishness. It's produced an 11% decline in IWM. Look at this. Look at the zigzag. Finally getting below 5%. So now we have a red tag there, finally. But what's fascinating to me is over the last 38 days, since August the 1st, there's been 38 trading sessions. Look at this. Earlier this year, we had declines of 7%, 7.75%. You think, okay, like this is actually pretty weak compared to those two moves. But check this out. When you look at the rate of change over a 38-day period, because that's, since July 31st, we've had 38 trading sessions. So since this high close right there, we're down 5.86%. You can see it right there, 5.86%. Look at these two periods over here. Over 38 days, we never got below 5%. Even though that was a 7% drop, they were so quick. But over a longer period of time, we were never down that much. In fact, if I zoom out here, you can see getting below 5% is a kind of a level where you don't dip below on pullbacks, but you do dip below on intermediate so there's your intermediate declines. Your intermediate declines synonymous with pullbacks. You do dip below that 5% during corrections. And we are below that, right? Minus almost 6%. So, again, it's only a couple of days. We can turn right back up again, I'm expecting we'll go up on Monday. It's just a matter of how much. And that's going to be an indication too. We didn't get to that. How much can we go up before things reverse themselves, right? Well, we need to get into this gap. At the very least, we need to get into that gap for us not to be bearish anymore. For this whole idea of a correction coming to be like nullified, right? To nullify all these signals we've got, we at least need to get into this gap. You can see the Qs tried today, and it didn't. It failed, right? We got up to it and failed, and we got down and finished at the lows of the day and formed a new 4-week low point. So we're still at 100 there. So we need to do that, and we'll see if the Qs are able to rally enough. SPY, You can see IWM, like they've got some ground to make up. We have to have a really strong Monday if we're going to even just get slightly into the gap, much less get all the way through it, which is what we really need to see to, again, change things around. And that's not something I expect that we'll see end up happening here. But as you saw with that rate of change and with that zigzag again, that's a small number compared to these two, but it's actually a big number for the amount of time that we've been this bear. Usually by now, if this is just a pullback, by now we're coming back up, right? Because 38 days is a long time. So we're coming back up, as you saw with the last two pullbacks. But when we're this bearish for this long, it generally means that we're going to be more bearish for a little bit long, for however much longer. And we're going to get a bigger tap, probably closer to the 10% like we got here when we started that correction. You can see we were 12% there when we started the COVID correction. We had 9% when we started that correction, 10% when we had this quasi correction there, 12% when we started that correction, and then so on, right? So you're probably going to be looking now closer towards the double digits. As I said, we already have seen on the Russell. The Russell is down 11%. It was down 14% on the banking issue. It's down 11% off of that peak. So, it is showing, the Russell is showing the levels. The NASDAQ, of course, hasn't been so bad. It's been fluctuating. It's got a few 5% declines here, but it hasn't been so bad. But we'll see what ends up happening. But you get the idea. Like it appears more and more likely that we're not necessarily like washing out right now. Like, oh, like this is like we're so bearish that we have to kind of bounce up, similar to other times we've washed out. No, it looks like we haven't even washed out at all. In fact, it looks like again that this is the beginning stages. Like a washout will probably end this correction pullback, whatever it ends up being. I expect it'll be a longer term correction, but we'll end it with a washout move, with the VIX getting to those levels I mentioned to you earlier. That's what it appears like, kind of like 2018, how that correction ended up there. Let's look at the sector moves today and how they performed really quick. So we'll come out here to today alone, September 22nd, and we'll come out here to 5-minute chart. Again, you can see technology started the day strong. These AI companies, right, started the day strong. Energy, I mean, again, even at that last wave, technology finished the day outpacing everybody. Discretionary, not so much, right? Discretionary down big. In fact, you see the big change there. If you look at the relative rotation graph, which shows sector rotation, like you can see there's your big three, and they're moving down to the left. And if you look at it on a shorter time frame, here on a daily chart, there's your big three: technology, discretionary, energy, communication services. Like right now, staples, healthcare, utility, financials, they're moving up to the right. That is a safety rotation on a daily basis. Even on a weekly basis, you can see staples, utilities, healthcare are the ones that are moving up to the right, along with energy and financials, but they're moving up to the right. We're getting more and more of a safety rotation, and our risk asset classes continue to move over to the left, right? And you're seeing that here this week, especially when I zoom out to the full week, you're seeing that rotation. I mean, look at discretionary getting hammered with real estate down there, materials down, financials, energy, and industrials all down. Healthcare doing okay, along with staples and utilities. It's been a pretty rough week for some of these risk asset sectors, and when you look at the 12 grid for them, the 12 grid for some of these, you'll see dark pink shading in a red line. I mean, that's how close you're already getting on the communication services. You're at 52. Energy's got the bull tag forming here. You got clusters on materials, clusters on industrials, cluster on healthcare, cluster on staples, cluster on real estate, but everything dark pink shading in a red line across the board. Full on bearishness. That's not just a pullback. All right, that brings us to our trade idea of the day. I want to take a look at Visa. Visa looks very similar to the S&P, just barely starting a new intermediate decline. The intermediate line falling into bearish territory down there. Very bearish short-term sentiment, down 3% below the moving average. So more bearish than what we've seen from this stock. Looking at the long-term chart, you can see after a transition candle last week, which was a relatively bearish week in and of itself. That's what makes these transition candles so bearish when you get them here. We follow that up with a bearish candle this week and a red arrow, so the PPO is falling. Pretty bearish candle too, a pretty decent sized candle there. Looking at the 3 green arrow chart for Visa, you can see we have 3 red arrows, right? The MACD is bearish, falling below its moving average, below 0. Stochastics in the bearish territory. The moving average for the stochastics is in the bearish territory. You're filling in the gap between the 50 and the 200-day moving average. There is some pretty decent support pretty close to where we're at. So there's not a whole lot of downside potential until you break that. And really you got to break it by you've got to get below these lows from May to really get going because of the volume that's in this area here. So not a whole lot of downside potential despite the bearish patterns. You can see even the DMI showing a bearish breakout above 30, below 20 on the negative positive indicator. Looking at the RSI and the CCI, breaking below 40 on the RSI, well below 150 on the CCI. You can see breaking below 0 on the CCI there, on the weekly CCI. Looking at the Ichimoku cloud, you are breaking into the cloud, right? You have a negative rate of change. You have the green line crossing below the blue. You have the beginnings of a weak bearish trend. We haven't seen that in a while. So you can kind of see how things are turning south. There's not a whole lot of downside, and it's not like a huge breakdown. We're below the lower band. We are below the Keltner channel. The bands are themselves closing outside the Keltner channel, as you can see with the green dot. So things are definitely turning south for the stock here. So let's go over to, you can see the trade I've got working, selling the 242.5. I actually probably need to sell now the 240. In fact, we're going to do that because it fell there at the end of the day. So we'll sell that 240 strike. Let's put this position size that, confirm and send, and stick that through. Sell the 240, the mid 30 deltas there, buy 1 strike away. So that puts you in here. Let's cancel this one that we had working and analyze this trade. You can see, let's get rid of the other one. You can see a full position size, pretty decent reward. And when you set the slice now to break even and then set that slice onto the chart, you can see, especially if I pull up the intraday chart here, the stock really has to reverse back up to the upside, right? I mean, we have to fill in that gap there from Thursday, which is the same gap that the market would have to fill in to kind of nullify the bearishness for this to be, for us to get back, get back into the value area, approach up to that point of control. Like that's the kind of bullish move it would take to be able to take, for us to take a $500 loss, because that's what we're willing to take, is a $500 loss is what we're trying to make. So that wouldn't be a whim. It wouldn't get to that level on a whim, for sure. And we would want to be out of the stock in that case. So I like the setup here. It doesn't have to go down very far, right? So there's not a whole lot of downside towards that support, but it doesn't have to go down very far. It just has to stay down below that 240 level, and we get a pretty decent reward if it does. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow us on Twitter and Facebook as well, and like our posts there. Have a great rest of your weekend, everybody, and we'll see you all on Monday.